that's what we spend a lot of time doing is just educating. And that's how I raise capital too. I don't feel like, I need to like sell a whole lot of things. It's just, man, can you give me 30 minutes to show you how your current environment works versus what's out there?
All right, guys, welcome to another episode of The Report. Today, we are in the studio and we got a little audience today. Got some of my friends out from Hawaii. Shout out to Nico and Strat. And we got a yacht meetup this weekend, so super excited for that. First yacht meetup of the season. So stoked for that. And I got a special guest today who actually connected with for the first time out in Orlando when I was out there for Tyler Devereaux's events about a month ago. And we were talking shop, and now we're talking shop in the studio. I got my man, James McCabe. James, welcome to the show, brother.
Thanks for having me.
Yeah, dude. Appreciate you coming down, man. I got to ask you, the black on black, man, you're like on brand. Where's the black on black come from?
Man, that's a good question. I think it started when I looked back at pictures
Mm-hmm.
and I saw me wearing things with like big brands or big colors. I always kind of like looked at it like, not necessarily like what was I thinking, but I didn't love it. And so I evolved into like, I got rid of a lot of logos, and then black is, I think it's just my favorite color. All my cars are black, and it just evolved into that. And I'll maybe add like a little splash in with the shoes or a hat or something like that. But
I remember meeting you at the conference in Orlando at the Gaylord Palms, and Nico was kind of, I had just flown in, I think it was on a Friday, and she was kind of like showing me the lay of the land, and she introduced me to you, and you were rocking the black on black, and that was the first thing I saw. So yeah, we're always rocking the black on black here
that's
at the
it.
team as well. So anyways, man, so what part of the country you in?
I'm in Gilbert, Arizona.
Gilbert. Okay.
Yeah.
Not too far, dude. Not too far. So I know you got a fund, which I really want to talk about, targeting retirement accounts. There's trillions of dollars in retirement accounts right now in America. And I got a lot of questions about that, dude. But before you got into, real estate investing and everything that you're doing, what were you doing before?
Yeah, I think it was always kind of hard to define. I think that's a question that a lot of people have asked me, like, hey, what do you do? And I don't really know how to answer that. I've never really had a job. I bought my first rental property when I was 19, and I did sales. I did door-to-door sales, and then started my own businesses, and then invested in businesses from there. And so the retirement account, I had a history with that when we could buy houses at a discount, after
Mhm.
the crash, and people just didn't want their money in the market. And so we would go and acquire a house. We'd put tenants in it. We'd rent it, or we'd renovate it. We'd put tenants in it. We'd put it under property management care. And then we'd sell it as a performing asset to people's retirement accounts if they didn't want their money in the market. And so that was a great wave, but we knew it'd be a wave as housing prices, rose and we couldn't get the same cap rates. And then I bought into a business that really took off. I thought it was going to be like a little bit more of an investment, but it turned into being like a full consumption. And that was also based around real estate. I was going to buy a flooring company that was in Arizona that just wasn't getting much love and attention because they'd moved on to the national side of things. And they got they had these relationships with Invitation Homes and OfferPad and Open Door and Zillow. They were doing their flooring all across the country, but they were using subcontractors.
Mm.
And they just knew that like as the market rose, there were small margins. And if a subcontractor had their own job versus doing 2 or 3 of ours, they would choose their own job where there would be a higher margin. And so we needed to put our own sticks and bricks in locations, and that was quite a ride. We went and opened up 3 locations inside of 4 years, 8 different states. We're doing 400 to 500 jobs a day. We opened up a multifamily division, and it was kind of a crazy ride. Labor was an issue, finding labor. And so I exited that business, and I kind of knew that was coming. And so I was searching like, hey, what's next? Like, where am I going to like really build my whole future? And I landed on the fund space. I knew I had a network that I could build off of. And it was like, well, how do I monetize on that? Like that was the biggest thing. I just occurred for myself as a connector. Like if you need something, whatever it is, I feel like I could help you get it. And we started from there, and I had a great mentor that showed me the way in the fund space. And I've always loved real estate. I love multifamily a lot right now, but I love all types of real estate and kind of a way to bring everything together.
So I read there's about roughly $38 trillion sitting in retirement accounts in the U.S. right now. And, obviously with the shifting demographics, we got a lot of baby boomers that are retiring, and a lot of that money is going to change hands and needs to go to work. And so I'm curious, like, what did you learn from this mentor in terms of the development and how this whole thing came to fruition in terms of you starting this retirement account fund?
Well, it was the same thing. He was a registered investment advisor,
Hmm.
and everyone just got smacked in '08, and he was tired of it. And he approached a huge fund manager in the United States and said, "You guys are the brightest minds in the world. How did you not see this coming?" And his answer surprised him. He said, "Well, we did, but our PPM kind of kept us on the tracks. And so we had one of two choices: return all of our clients' money back to them, or just take the hit and pick our head up and see where we're at, once the train passed by." And that's the option that they chose. And he was on a mission to get out of that environment. And that's where he found alternative investments and private placements. And, when I started looking at it, it's like, where's there a need, in the United States? And I started learning more about traditional retirement accounts and qualified funds. And what I saw is that those vehicles like the 401k wasn't designed to be the primary source of retirement in the United States.
Mm.
It was designed to be a second or third option in retirement for executives that were making a $250,000 a year to get some tax deferred growth, but it wasn't designed to be the primary retirement vehicle. And if you look into it, you'll see some of the creators that were like, man, if we would have known what this was going to turn into, I don't know if we would have ever, created it. And then you looked at the switch and where it got out of hand is that, what is the number one, at least in my belief system, what is the number one liability for corporate America? Was the
Taxes?
pension.
Mm. Well, yeah, because before the 401k, a lot of career fields had a pension. It was a very normal thing.
Yeah.
I worked in a career field, and this was a very rare thing in today's age, but I worked as an air traffic controller for 11 years with the FAA. And if you did 25, you would get a pension. And I walked away from that, and I cashed out my 401 to get into real estate investing, and it was one of the best decisions I ever made. But I always say, when I got into real estate investing 5 years ago, that's all I had in my name was a 401k. And I maxed it out every single year. And yeah, it grew, but it didn't grow to the level to how what they say it will grow to. But I will say that had I not invested that 401k, I don't know if I'd be doing what I'm doing now. That was my seed money to get started. Right. And so as much as I am not a fan of the 401k, and as much as I believe it's a problem in America for a lot of reasons, which we can get into, I will say it's better than doing nothing. So if you don't have a plan with your money, I believe, okay, well, at least put your money in a 401k, get the employer match and let that grow. And at least you have some seed money to redeploy that into something else. Or if you just want to become completely passive, maybe you redeploy that into a fund, which you have.
Yeah. Well, I talk to people all the time, and I wouldn't have people hear that I'm anti 401k.
Mm.
I'm not a fan of the 401k being your primary source of retirement. But if a company is offering a match, take advantage of it.
Yeah.
Now, what are we doing above the match is where I'd have you start looking at other options to be creative. But, you look at the swing and where it's gotten so lopsided is that, to my understanding, the number one corporate tax write-off in America is the 401k match. So someone comes into your office once a quarter, once a year, and talks to you about all the benefits of investing in a 401k, and your company's going to do this 3% match. And why are they selling this? Like, why are they encouraging it? And it's like, well, the match is a huge write-off. And so if you have these companies that have an option to, like Boeing, huge pension plan, it's like it almost doesn't exist anymore because they've successfully shifted people out of the pension and into the 401k. And I don't blame Boeing for that. They're removing their number one liability, paying people in the future that are no longer producing income for them for their number one corporate tax write-off. It's a no-brainer. And so what I spend most of my time doing is educating people on how it operates. I think so many people are just setting it and forgetting it.
Mm-hmm.
And, and so where I feel like I'm gaining traction and a lot of momentum in raising capital is just educating them simply on how that vehicle operates. And then I think people are big boys, big girls. They can make their own decisions from there. And it just so happens I've got something for them to look at that might align for them more, which might be a fixed rate of return backed by a hard asset. And now you're diversified. You've got, an active job that you're contributing to. It's in taking advantage of the market. You're getting a match from your employer. but you may have had this former 401k, and rather than having everything in the market, you can deploy it. You can get some compounding interest. I teach people a lot about the benefits of compounding interest, and now you can diversify. And what I found is that when you can when people can bet their retirement on a hard asset, it aligns for the majority. And so I'd sit and talk to people, constantly about that. A principle I love to talk to people about are losses are twice as bad as gains in that environment. It's unbelievable. Rich, I talk to people and I just do a simple exercise with them. Hey, if you had 100 grand in your 401k
Mm-hmm.
and the market dropped 50%, what do you have?
50 grand.
Yeah, and everyone says 50 grand. All right, and that hasn't happened a whole lot, but like since 2000, it's happened a handful of times. Right? You had the .com and 9/11 and the crash, and COVID was kind of trending that way, but we printed a bunch of money to kind of get it back up. Okay. Well, the market goes back up 50, percent. What do you have?
75.
Yeah, and you'd be surprised. I mean, if I ask that question to 25 people, I think 22 or 23 are saying 100 grand. And it blows their mind that this math, and when you break it down and then you look at the fee structure and then you just show them another option, it's like, man, yeah, I want some control. And so I'm a big believer in the self-directed IRA and taking a little bit control, but I'm not anti 401k. I don't love when people are all their eggs are in that basket.
A lot of our investors invest through a self-directed IRA. I would say with our hotel fund, maybe 25% of our investors are through a self-directed IRA. So I'm a fan of that, but man, so the reasons that you mentioned, dude, it's not just that. It's I think the 401k was built for, you could argue, it was built for the Wall Street. It was built for the US government because, Wall Street's making fees on your money as it compounds, and you could lose money. You could, like you just mentioned, you could have a negative return for the year in terms of performance, but Wall Street's still collecting their fees depending on the custodian. Those fees are going to add up. And then, the reason I say it was built for the U.S. government is because you're kind of investing their tax money. So if you think about it, they say, hey, you can't take the money out till age 59 and a half. Well, this is a slice of your hard-earned income and time that you're never going to get back. Imagine going to your bank or your credit union and saying, hey, I want to do a withdrawal today. And they say, hey, James, you can't touch this money until age 59 and a half. Well, for a lot of folks that are in their 20s or 30s, that might be 20, 30 years away. So that I don't love, right?
Yeah.
It's like, this is your own money that you work for, and now they're saying that you don't have control over it. And then to take it a step further, at age 72 and a half, I believe it is, they say that if you don't start taking withdrawals, they're going to start penalizing you because they know average life expectancy age is about 77 for most Americans. And at 72 and a half, they don't start collecting their taxes on that money, you might die.
Yeah, and they frame it up pretty great, right?
Mm-hmm.
They're not calling it a penalty. They're just going to assume that you took income, and you're just going to be taxed accordingly. And I'm with you most days. I would say about 50-50. I like the restriction to 59 and a half because my experience in sitting down with people oftentimes is that not everyone has the discipline to save for retirement. And so this kind of, it's going to hurt if you take it out, is kind of, helping people go and gain $250,000 in savings or $300,000 or $400,000 in savings. I think it helps to that, but you get me on the other half of the week and it's like, no, like, what you could be doing with that money? Like if you could take that out and put it to work, it's a big advantage.
So I took my money out, and I had, after 11-year career, I had about 350,000 in there after 11 years of like maxing it out every single year.
Yeah, good for you.
And it grew, right? But it didn't grow to the level that they say it would. And I did pay the 10% penalty to the Fed. I did pay the 2.5% penalty to the state of California. But to your point, why is it my right to donate, or why am I obligated to donate 10% of my earnings to the federal government for investing into a 401k?
Yeah. Yeah, I mean,
You know what I mean?
their portion is, we're doing this for you.
But what are they doing for you?
We're going to make it sting so bad. We're going to charge you an additional 10% or additional 12% to take this out because we don't want it to. We want you to be able to retire with dignity. And if you're only 30 years old and you've got 350 grand in an account, well, we want that to grow another few years, until you're 59 and a half, so you can be self-sustained in retirement on your own. So it's like, I can get behind that most days, but there's the other half where it's just like, come on, this is our money.
Mm-hmm.
Let us do with it what we want. And I just don't know if there's enough disciplined people to save. I think that our country is a big consumer country. we like to buy. I think social media plays into that. Like, it's so easy to just press a button and consume and press a button and consume. So there's just half. I flip-flop. It's kind of a weird, it just depends on what day you catch me on. It's like I love the 59.5 because it's helping people, grow their savings. And the other part, it's like, man, it's such a shame. You've got this great business idea to go and start a business or an investment, but to pull it out of that vehicle is gonna cost you, 2
Mhm.
years of your hard-earned income in that savings or, whatever it may be, and that's the part that hurts.
Yeah. And if you look at the 401k balance by age group in America, you know, 30s, 40s, 50s, 60s, 70s, those numbers are a lot smaller than you would think. And if we're talking retirement, a lot of people are banking on the 401k for retirement. A lot of people factor the 4% rule. And what is the 4% rule? So typically, whatever your retirement account balance is, you take 4% of that. It's the safe withdrawal rate. And so let's just say for simple math, if you had $1 million, which we consider really, really well, really good for most people, $1 million of retirement in a 401k or an IRA, 4% of that's 40K. And then you got to pay income taxes on that 40K. And oh, by the way, this is 20 years from now, 30 years from now, with inflation, the cost of living going up, that's not really much to live off of. And so I think it's a broken system. And if you look at the average of if you look at the median 401k IRA balance at retirement, 50, 60, 70s, I don't have it off the top of my head, but it's pretty low.
I looked at Fidelity's rates last year, and you'd have to fact check me on this, but I believe, how old were you when you cashed yours out?
I was 33 when I cashed mine out.
I would be willing to bet that your 300,000 plus at 33 was well above the national average for a 50-year-old.
Yeah, and definitely for someone in the 30s.
I want to say it was like less than $250,000 for a 45-year-old in their retirement right now. I think at 33, you're well ahead of the game.
Hey guys, real quick, the only way this show grows, the only way we continue to bring on bigger and better guests is if you guys rate, review, and share the show. So if you could take 2 seconds or the click of the thumb to review on Apple or Spotify, it will mean the world to me. But more importantly, we'll be able to reach more entrepreneurs and more real estate investors and help them build wealth through this podcast. Now back to the show. So anyway, this is median 401k balance by age. It says 35 to 44, 28,000. 45 to 54, 48,000, 55 to 64, 71,000, 65 and older. And this is the median, not the average. The average is going to be a little bit higher because I think there's folks out there that have $1 million plus, and that brings the average up. But this is the median, meaning half of the 401k holders are above this and half are below this. But 65 and older, this is when most people are hitting retirement years, 70,000.
Yeah.
So take 4% of 70,000, that's $2,800 a year. So you're telling me we're going to live off of $2,800 a year? Oh, but you got Social Security. Well, good luck.
Yeah.
Because there's no guarantee that Social Security is going to be around that.
Insert the Walmart greeter, insert the Uber Eats delivery driver, the 65, 70-year-old, delivery driver. It's because that's the state of our country right now, and that's a big part of, the vehicle that we created was designed for the people in that state. That was just like, geez, if I could have had a fixed compounded annual return, I could have planned for that. But to have a vehicle where losses are twice as bad as gains, I don't think it aligns for most people to be in that environment in the second half or in the last quarter of their career. So when you can introduce them to your fund where they can go and have an option for a higher return, or what we provide, a compounded annual return secured by an asset class, it's like, yeah, it tends to be a no-brainer for people. The education is just not out there. I try and teach people the rule of 72.
What's that?
Einstein called it the eighth wonder of the world. The number 72 is pretty cool. Like, if you look at it in astrology, and there's some connections to the pyramids and those kind of things, but it's how compounding interest works. So you take the number 72 and you divide it by the interest rate you're getting on an annual basis, and that will tell you how often your money will double. So we issue a 10% compounded annual return. Your money doubles with us every 7.2 years. Well, you can plan on that. Somebody at 44 years old has a former 401k, that they saved up. Let's use your example. You're 33 years old. You could have come and put that in our 10% fund. Well, how long until you're 59 and a half?
At 33 to 59, that's what, 26 years?
26 years. So you start doing some math, you're going to get 3 doubles on that and some change before you even have access to it. So you take 300 grand, goes to 600 grand. Yeah. So you go there. Now it's like, there's your safety net. There's your now you go and participate in another match or a 401k that's exposed to the market. Now you go and get a rental property, or you go and invest in another fund, and you can diversify and you can plan, but there's no more of like the fingers crossed. And it's a shame that people are later in their career and they're doing the math even on the doubles, and it's like, and they start reaching for other investments, and they start, and that's how people get hurt. But it's just a shame. I think that they should be teaching things like the rule of 72 and as early as elementary school. And I'm sitting down with people in their 50s and they've never even heard of it.
I never heard of it till right now.
Yeah.
Yeah.
Yeah,
So
that's
first
the
time, man.
point example.
You're educating me.
What's amazing of compounding interest, you've seen the example of the $1,000,000 or the penny that doubles every day for 30 days. You seen that?
I've seen some of it. So how many times it has to double to hit 1,000,000?
Yeah, well, you ask people, would you take $1,000,000 for this penny?
Mhm.
And they're like, oh, yeah, the cash, I'll take the million. Okay, well, what if this penny doubles every day for 30 days? Which one are you taking? And I'd put a timer on them. 3, 2, 1, and
Yeah.
and most people, I'd say 7 out of 10 are like the million. It's like, well, why? It's like, it's $1,000,000. Like, I'm going to take the guaranteed. Well, you do the math, and there's 2 ways to do it. I've seen it end up at 5 million and end up at 10 million. But at day 10, you're at like $10,024.
Mm. And then you get
Oh,
20
no,
more
no,
doubles.
you're only at $10, I think, at day 10. And at day 20, you're at 10,000. At, day 25, you're at like 330,000. At day 27, you're at like 1.3 million. And on day 30, you're at like 10.7 million. And that's the benefits of compounding interest when you can get those doubles. And that's the preaching of start early. If you could start putting $500 a month away in your 20s or in your early 30s, what that can do from a compounding aspect. But it's like, well, where do I get the compounding? Because, the market's up and down. If it gets an average of 4 to 6%, or like, where can you get these vehicles for compounding growth? And that's really where the idea of our fund to issue a fixed compounded annual return, because we believe in get more momentum, at least as a financial advisor might call it, like the stool of 3 legs. Like, we could serve a purpose as one of those stools, as something you can count on. Oh, and guess what? It's backed by a hard asset. It's secured by an asset. You go and buy a stock. What's your security in that? I mean, Amazon's not issuing a security based on their real estate holdings. You're just hoping that they continue to rise at the rate that they've rised. And if they don't, you're participating to it. And so that's what we spend a lot of time doing, is just educating. And that's how I raise capital too. I don't feel like, I need to like sell a whole lot of things. It's just, man, can you give me 30 minutes to show you how your current environment works versus what's out there? Have you heard of Rich? Have you heard of his, boutique hotels? Have you looked at that? Have you seen why people are entering into that market, or why, it's like, it's just an education. And that's why I love social media. And that's why I was excited to get to know you at that event. And it's like, man, you're teaching people in a form that I like learning from. Your short form content of your conversations around people and how they're interacting with creating or generating wealth or investing or in real estate. And it's like, man, I believe it's as easy of time to make money in the world. It's just, enough people got to learn how to do it.
I mean, the money's out there, man. Government's printed about 80% of the money supply in the last 4 or 5 years. And I don't think that's going to stop. So I think, inflation's going to continue over the long term. And, I think the money's out there for the folks that want to go out there and get it. It's definitely out there. I was having dinner the other night, and I was where the girl I was with, she was talking about, this whole like feminine movement that's going on right now. And I was saying, to be a guy right now in America with this big feminine movement, it's tough because a lot of women are out there getting bachelor's degrees and master's degrees and they're becoming doctors and attorneys, and like, I don't need a man, and and that whole thing. And so I feel like there's a lot of men out there that are, 35 years old right now that are kind of lost. They don't feel like they're needed, and they're maybe playing video games at home with their parents' house. And it's tough. And I told her, I said, as much as it is tough to be a guy right now, I think for the guys out there that are hungry, that have a goal, they have a target, and they desire something bad enough, you can run a lot of these guys over right now. And all the money that's being printed, there's so much money in the world right now, and it's out there. You just got to go out there and get it and make it happen. And so for the folks out there that are serious, you can run these guys over.
Well, I love a strong woman, from that standpoint. My wife has always worked with me. So
what's your wife's name?
Her name's Lex.
Shout out Lex.
Yeah. She is.
She's out in Gilbert right now?
Yeah, she is. And
you should have brought her on the yacht meetup, man. Come on.
We will. We've got a little party tomorrow for our 8-year-old. So,
okay.
Or else she would be here. But she's always ran operations for anything that we've done. And it's from a standpoint of, she saw her family members lose everything in the crash, and it was like, "That will never be me, like, I'll always be self-sufficient." That was important to her, but where I think that we've benefited the most is that entrepreneurship is tough enough as is. When you can have somebody that is supporting you in some way, shape, or form, whether that's just simply believing in you, encouraging you through the lonely or the hard days or whatever it is, like, I believe that's almost the secret sauce. And so the one downside I struggle with, with this movement is that it's almost like the dual income. Like, no, no, I'm helping. I
Hmm.
can go make 100 extra grand a year too. It's like, yeah, but if you could just support me and take 25% off my plate,
You can make a million.
yeah, like watch what can happen. Watch the ceiling or the ability. And so, yeah, I've got a wife that it's hugely, she believes in that a ton.
Well, I'll take it a step further. I think this is something that's not talked about a lot, but I talk about it. I think for a lot of these women that go and become doctors and attorneys, and I think that's great if that's what they want to do. But I think when they do that, they're actually setting themselves up to attract a more mediocre middle class man that actually values the dual income. I think a lot of high value men out there actually value a partner that's available and has the time versus someone that's working 6 days a week. I know a lot of attorneys that are women, and they're working 6 days a week. They're working all day Saturday, and then Sunday's like their only day off, and they're like already thinking about the next week, and they're just like always stressed out, never available. I'm like, dude, I don't. When I was younger, I did value a woman that was a high income earner because I thought the dual income would be good and we could live a comfortable life. But now, as I've grown, I value a woman that has availability and time. And so it's interesting how that shifts. But I say all this and that women that go do that, but then they value getting married and all that sort of thing. They're actually setting themselves up not to attract the man that they're looking to attract.
Yeah. And I wouldn't have it look at like, oh yeah, get the women home and the kid, like you take care of the laundry
Like
and
a
the like,
domesticated
no,
role.
like take
This is
like
turning into a dating podcast. Let's go,
support,
James. Let's
like
go.
support whatever that is. Listen, for
Talking
me,
to Michael Sartain over here.
I did the laundry. The reason I did the laundry is because I'm particular and I wanted my closet color coordinated and I wanted a certain way that wasn't as important to her. Well, it's like, yeah, so what else can you take off the plate that would allow me to go create? It's like, it doesn't need to be whatever's traditional in the 50s, but man, when you could come at a goal together, I think the ceiling's so much higher than us and our own journeys over here and then combining our efforts in a combined bank account. It's like, man, if we can get aligned in one goal, eyes on that prize, like watch what can happen.
Yeah, yeah. Okay. I like that, man. Talking about doing laundry. I like it. I like it. And shout out to Lex.
Shout out to
She
Lex.
does your laundry?
Now we've got some other help that takes care
Okay.
of that.
Okay.
Yeah. It's in the same name. We hired a house manager,
Okay.
and that's been a huge life hack for us. Because we're building these businesses together, what we found is that, we work around the clock. And she loves to go from 5 a.m., before anyone wakes up. She's got her routine, and that's when she handles a lot of the busy work. She does our client onboarding and our SEC regulation stuff. So she handles all that. She just likes when no one's bothering her. We spend time with the kids. We get them out the door. Then we go build the business during the day. We like one of us to be there to, for the kids when they're off, school, to be with them. Well, you go do that. Then you do through homework, and then you go through dinner, and you go through bedtime routine, and then you go through cleaning up. And it's like, at the end of it, like, where's the time for us? You're just
Mhm.
exhausted. And, you got another early morning meeting. I got a partner on the East Coast. He might have teed up a meeting at, 5:30 a.m. because it's 8:30 East Coast, or, whatever it may be. And so we started to look, how can we get more efficient? We started with somebody that came from 7:30 to 8:30 every night. They did our laundry for the day, and they just cleaned the house. So vacuum, dishes, everything. And that gave us time for us. And that's where we were allowed to date. We go on walks, we go out and grab a quick dinner or whatever. Like, we do something like that. And then it evolved into what we call a house manager, because our kids are at school. So it's not really a nanny. It's just an extension of us. And it's like, all right, what needs to get done in our family? And what do we really like doing? And what do we not like doing? And where can we get some help? Because that's a part of it. Some people are like, no, like, I'm supposed to be the mom. Like, that's supposed to be my job. It's like, no, like, if you don't like it, let's get some help there. And let's let you spend time on the things that you actually like. And so, a little rant there, but a house manager's been a huge game changer, and she's just a full extension of us.
Yeah. So I think there's like 3 levels. It's like level one is someone that in terms of dating as a guy, right? You're dating a woman. I think there's 3 levels. So like level 1 would be like a woman that's you're dating and she doesn't really understand how business entrepreneurship works and she's like whatever, doesn't care about it. Level 2 would be like a woman that supports what you do and is like totally cool with it and supports you in any way they can, but they're not in the trenches. And I would say level 3 would be like a woman that's or a spouse that's like in the trenches. They're building it with you, like grinding and like building the business with you, like next to you. I think I would be okay with like a level 2 or a level 3. Would you say that your wife is like a level 3, like in the trenches, grinding? She's like waking up with you, like freaking like pushing the business forward every single day.
Yeah, she's ops. I mean, I think we had in our last company over 150 employees, and the majority of them reported to her in some way, shape, or form. Like she is systems oriented and she possesses a lot of qualities that I don't. I don't sit still very well. I want to be out networking and creating and, a vision. She's the one that brings the vision to life. The obstacle that's come along with it that we've seen over the years is that what people would hear when you work with your wife, or your spouse, is that it kind of seems like a little small time, right? Like it seems like a little ma and pa, but she's a monster. She had a goal she wanted to be a CEO of a $100 million company,
Mm.
and so she thought that was going to be like the corporate route. Like she was going to work her way to do that. And I'll take a little credit for introducing her to entrepreneurship and showing her that that can be our business, and from there. So she's a 3, and I think that's had a season, and I think that she's now closer to a 2, and I would imagine in the next 18 months she'll be a 1. I think she'll always oversee the financials of the funds, like like she does. Always do a wire.
You're taking her from a 3 to a 1. You're
She
phasing her out?
is.
Oh, she's taking herself
Yeah, I
out.
think that
Okay.
that's the season of life that she's in. I think she feels comfortable. She's entertained the possibility of law school.
Mm.
She's just tired of
Dude,
attorneys.
I was just talking about attorneys. She's gonna go to law school?
She thinks it's more efficient for our goal is to be a family office.
Got it.
And so we would have in-house counsel at that point. I
Mm.
think the qualification for that's like right around 30 million. And that's when you can start justifying having in-house counsel and, those kind of things. And recently she's thought, hey, I think I want to replace myself in the business and look more towards the future. And I think a part of that might be going to law school and being able to drop our contracts for us or something, because she always wants to stay. I don't think she'll ever sit still, but I think the season of her being at a 3 is phasing out a little bit.
But I will say this though. I will challenge you in this way, like similar to like your laundry thing, right? You got the house manager coming in, not the best use of your time. I would argue her taking a step back, going to law school is like just so you can save on legal costs. That to me, I don't know if that's in line with like scaling and growing. You see what I'm saying? In terms of
So
like a
I wouldn't
ROI.
look at it from a savings. She
Yeah.
doesn't want to deal with attorneys anymore.
Mm.
She's struggling with, her words would be like, I just want an attorney that speaks
I
English
sure
to
as
me.
am. Yeah.
They overcomplicate things. I think I would serve the business by staying busy and doing that, but not from like a above the line aspect of the business, not like from a profitability standpoint. I mean, legal fees are. I mean, you might spend $100,000 in legal fees on a year. Like
Dude,
she's
I
not.
don't know, man. Some of these legal counsels are expensive. We had
Yeah.
one.
Well, let's stay out of trouble and
we
keep
had-
that around $100,000. And
The one that set
doing
up our
kind of
fund
stuff.
was like it was like 78 G's.
Yeah,
Yeah, it wasn't cheap.
but those are just up front. You could
Yeah. One
copy
time-
and paste that essentially now, right?
One time thing, but that is on the high side for SEC counsel. Now we use Bethany LaFlamme. Shout out to Bethany.
Shout out to
Bethany will actually be on the yacht meetup tomorrow night. She's coming out.
Yeah.
But anyways, yeah, man. It's I always thought like, if you're building, I think a lot of American couples divorce because they're not growing anything together. They're not working towards the same goal together. They're not building anything together. So I always thought, I think it would be cool to like build something cool with your spouse or your wife. Build a business, and then now you're building and working towards the same goal. You're growing together. You're progressing together. So I always thought that would be kind of cool. But like I said, level 2, level 3, I'll make it happen.
It's translated into one of my favorite things about our relationship, because she's been we'll call it your level 3. She treats things as she would in the workplace.
Mhm.
And so what could be like an argument that turns into drama or whatever it may be, because she has so much experience in the workplace, and putting out fires and building businesses and doing all that, she handles things from a really logical approach. At least that's how it occurs for me. And so I love the what it's allowed us to do from a communication standpoint. Like, it's like, "Oh, yeah, we've got an issue, all right. You fixing it or am I fixing it? Like, but let's move on," you know? When we get to a fight, we have this saying, uh, it's called make up or break up.
Oh,
That she can't, like, you know, so if we're arguing about something, one of us will put each other in check, like, "Hey, make up or break up." And essentially we're saying, "Is this worth breaking up over?" And if the answer is no to that, then let's start making up and let's move on. And this approach that she has, I think has made it really cool. And I attribute that to her spending time and learning how to build a business or operating a business or, you know, being in the workplace or whatever it may
yeah.
be. Yeah.
Love that, dude. So I want to transition a little bit. So I know you're doing real estate investing, and I didn't know this when I met you in Orlando. I thought you were just on the capital development side solely. But when you came in tonight or today, by the way, we never record on Fridays, always Wednesdays. So we got a VIP guest today, I
Thanks for
guess.
making an exception.
So you do active real estate investing as well. Tell me a little bit about what your portfolio looks like and what kind of assets you guys are buying.
Yeah. So right now, I'll tell our clients, like, don't be surprised if 9 out of every 10 things we acquire right now is multifamily, 50 units and above. Our most recent was a 203 unit property in Des Moines, Iowa, and it's great. I mean, the stabilization process has gone really smooth, and we think that the multifamily space is in a little bit of trouble right now. And the term that we're using to our clients is a somber excitement. You know, we don't think it'll ever really align for us to celebrate people being in trouble, you know, from a capital stack issue and with being these bridge loans that they were doing 3 years ago. But from a business standpoint, like, we're certainly looking to take advantage of it. And so we've got our blinders on a little bit to multifamily. But this last year, we acquired a ownership position in a service-based industry, a pest control business, and that's gone phenomenally well, you know, and we just structured deals where it makes sense. I really love structuring deals around a hard asset and having some sort of collateral. With that, that was a little bit different. We're looking at my buddy most recently. Actually, I got to be careful. I don't know if I'm allowed to say it, but he's got some groundbreaking. You give me another month, I'll be able to tell you what it is. But we're going to put a little bit of money towards that. But 9 out of every 10 things we're looking at is multifamily or some form of commercial-based real estate.
Hmm. And so with the real estate stuff, the apartments, are you guys partnering with someone that's operating or are you guys self-operating?
Yeah, so we own an asset management company. You know, one of my board members, she said something to me. She's a monster. She just broke the price per square foot record in Arizona. You know, she has a house. I think it's going to be the singular best house in all of Arizona. She's had some professional athletes offer $30 million for it, and she just turned it down right away. She thinks she's going to sell it for 40 million. Like,
Mm.
she's doing some things, and she's our age. You know, she's 36 years old, I believe, right now,
Hmm.
and she's amazing. But she's always talked about the ability to turn capital. You know, like, how quick can you turn it? So in my funds, we do a 4-year note. She was like, James, if you turn the money once in 4 years, you'll have a successful business. You know, if you turn it twice, you'll be very, very wealthy. And if you turn it 3 times, you'll be a monster. And so where we put in the asset management side of things is in control, which would allow us to have liquidity events or refis or whatever it may be and continue to put that money to work inside of my 4-year window that I have. And we think we have a pretty high renewal rate because we're doing it with retirement accounts. And if they're not 59 and a half, where else are they getting a fixed 10% compounded annual return? So
Mhm.
that's the game that we're playing, and that's where asset management comes into it.
Yeah, I think asset management is really important. So here we have a management arm, so we are doing the day to day, which gives us full control, and then we do the asset management as well, which I think is very important. But especially if, like when it comes times like pivoting, you don't have to sit down and have these grueling meetings, or we can just make a decision when we make a pivot, and then boom, 10 minutes later, like we're off to the races. Which is good. But that said, man, so I'm just trying to like get a better understanding. So you got the asset management company, and then and do you guys have partners on these deals too?
Yeah, yeah. So, like, we met at a conference.
Yeah.
You know, shout out Tyler. You
Hmm.
know that he's teaching people how to syndicate.
Hmm.
If somebody found a great deal and they weren't quite sure what to do with it after that, you know, we could fund it, we could manage it, you know, and keep them on as a GP partner. We like to keep our deals pretty tight. You know, like, that's our business model. We, on the $75 million fund, we'd like to kind of keep things in a $5 million range, have 15 projects per fund. And so we just opened up the placement fund 3 that I'm excited about. And what would be really beneficial to us is somebody that came and brought us a good deal. And then we fund it and manage it and we're partners on it. And so that's what would most likely look like a partnership with us,
Yeah.
like from a business model standpoint. If we've got a really good operator, to learn from them, like we'd love to do that. Maybe like asset manage, or split some of that GP or something like that. Create a syndication split or maybe like a 70-30 split and allocate a portion of the asset management and learn from somebody that has more experience. So like we'd be up for that. But that's most likely what it would look like partnering with someone else.
Yeah. So what does this new fund look like? Tell me a little bit about that.
Yeah, I think most people would look at it and call it a debt fund. And
Just because
we would even call
fixed
it
10%, no upside, no tax benefits,
yeah, so there's
but compounding.
they're not LPs.
Yeah.
We're issuing promissory notes. And then we're securing it with the assets in our funds. Whether we've already acquired it or we acquire it in the future, they can secure it by the assets. So we issue a fixed 10% compounded annual return, and that goes for 4 years. The reason we did it for 4 years, if we held it for 7.2 to get a full double, we feel like that's a pretty long time to hold capital. We like our, what we believe our turnover rate will be, or our renewal rate will be.
So is the capital return at 4 years, or it's liquid at 4 years to where they can withdraw it?
It's up to them.
Okay.
Yeah, so we do a 100-day review, and they can decide to re-up for another 4 years. Hey, I'm only 52, like let's keep it rolling. If it's liquid, some people might say, hey, I'm going to take my interest and I'm going to keep my principal rolling. We have an option where you can extend for 12 months or 24 months, where it's like, hey, this has been great. I don't really have a place to put it yet, but I don't know if I want to lock it up for another 4 years. So we have a couple different options like that. And then we have an 8%, what I call it a liquidity note, where if someone's looking for income, they give us $1 million, we'll pay them an 8% on an annual basis where they keep their principal intact, but they're, $80,000 a year that we can pay on a monthly, quarterly, or annual basis.
What's the 8% option? Remind me.
Yeah, so I have an example. Someone just sold a business. He's just missing cash flow. It was kind of crazy. I'm actually pretty proud of this. It's my first $1 million investor I've never met. And so he was a referral, and we were introduced through email, and I said, hey, I'd love to meet you. He's not where I'm from, so I said, let's set up a Zoom. He's like, no, if you're good in his book, you're good in mine. Just tell me where to go next. Wired $1 million, and he just wants the income. He just misses the income. So we issue 8% on a monthly basis.
Love that. And the difference between the 8 and the 10 is what?
It's not compounding. So at 8%, if we can't keep it to work it, we issue a little bit lesser percent. So,
Okay.
Like we can issue 8, like, you might have an 8% pref in a multifamily deal you do or one of your hotel deals. So we feel really comfortable, and it's only a small portion of our clients that would do it, less than 20%, because so many people are looking to grow. They're looking to build up those numbers that you pulled up earlier around retirement. They're looking to be able to retire. There's a smaller amount of people that are looking for income, but that's kind of our journey with us. So we've got a 3-part journey. One, our 10% note, it compounds annually. Pretty simple. You have $100,000, you make $10,000 year one, and year two, you make 10% on $110,000, and it just keeps compounding. The other option is our 8%. I want some sort of income. I want some disbursements, some distributions, and you can choose a monthly, quarterly, or annual basis. And the annual might be a benefit around taxes. If you had a big year, you might want to defer it till the next year or something like that. And we can be flexible, have some workability around that. And then the other option is, once you're a client, if you'd like to participate with deals with us directly, then we open that door for you. So it's like, hey, I like the 10%, but what are you making on that 203 unit deal? It's like, oh yeah, I want to be a part of that. It's like, great, we'll become a client and we'll open that door for you. And they can participate with deals with us directly.
So I didn't know this, but I've done 3 now, to where we offered some sort of debt portion to the investors. And I didn't know this, but our SEC counsel notified of this, and I haven't fact checked it, but they said even though it's debt for these investors and there's no equity, if it's secured with some sort of real estate project and you get a cost seg, you can, as a GP, decide to allocate some of the tax benefits over to the debt investors. And I didn't know that was an option. I thought that was pretty creative.
I'd be really interested to learn about that. I think that'd be a huge benefit to be able to pass that on.
Yeah.
Yeah.
Because as a GP, I feel like, you keep buying and buying and buying, you only need so much depreciation. So you don't want to let it all go to waste. And so why not flow a little bit through if there's enough to go around, you know?
Here's what I'm finding is that who has 401ks? typically. W-2
Yeah.
employees. W-2 employees tend to not have a whole lot of, uh, things to write off, like, write off and that's not a word, write-offable income, but, there's not as much of a need. But for our more liquid investors that are investing cash, that would be a huge benefit to be able to pass some of that on.
Yeah. And dude, I didn't know this, but I had Amanda Hahn. Shout out to Amanda. She's actually going to be on the podcast next week. But she was on my mastermind call, our hotel mastermind, like a few weeks ago, and this was kind of new information to me. But she was saying how our investors in our fund, that investors self-directed IRA, I always was under the impression of like, hey, like who cares about the tax benefits for them? But she was saying it matters because when we sell these assets in the fund, they're going to have some sort of tax event or something to where the depreciation actually does matter for them. And, obviously I'm not qualified to speak on exactly what that looks like, but I am going to ask her next week when she comes on.
Yeah, there's certain qualifications that I understand. One, ERISA plays into that. There's some sort of tax penalty when you're going and participating as an LP in an investment. And then in the fund world, oh no, that's sorry, I mixed up the two. UBIT taxes, I believe is what it's called, is that you might have some exposure of UBIT taxes if you're investing directly as an LP. We don't have a whole lot of that, so I'm not overly confident on speaking around it. And then from a fund management standpoint, you have certain regulations around how much qualified funds you can bring into a fund before you're essentially a pension plan. You're like your retirement fund. And because we're issuing debt via a promissory note, they're not investors, they're clients, essentially. So I don't use the term investors a whole lot because they're just more so clients that we're issuing a note with.
Yeah. So what do you call them? Just clients?
Yeah.
Debt clients?
Yeah, clients, note
Yeah.
holders.
Holders? Note
Yeah,
holders?
note holders.
Okay.
Yeah.
I like that. Yeah, we do like kind of a class A, class B. So we'll give them two options. So like class B would be like equity in the fund. And then class A would be like just a fixed monthly return. And it would be secured by like a promissory note with a personal guarantee that is backed by the real estate. However, we just call class A, class B. It's just, I don't know. Yeah. I think people when you start using the word debt, they get like, it's not for a lot of folks, it's like a bad word.
I love that model. We're pretty like in our lane because we believe that there's a real need for it. The other part is that I wanted to have a vehicle that my 8-year-old could understand. When you're raising capital and somebody doesn't have much investor experience, but they meet the qualifications of being an accredited investor, and you start explaining class A and class B and prefs, and it almost, in my experience at least, you can see the glaze over of confusion, and then the confusion turns into making them nervous, and then because they're nervous, they might not move because they don't fully understand it.
Mhm.
And so
A confused mind doesn't act.
yeah, and
Yeah.
so I would look to that's what my first step would be if I evolved into that lane. Is how could I explain it in a way that wasn't intimidating? And class A and class B and
I agree, dude.
those kind of things. And I think the people that can master that delivery will have a ton of success, and it'll serve a huge purpose for the people looking to place their money.
I agree, man. I think it's good to have two options. I think with our fund, it's a 10-year option, kind of a long-term play with benefits upside, but then like, hey, we get this other option as well, which is a little bit quicker turn of money, if you would. But dude, to your point, man, I think a confused mind doesn't act. I've done syndications on the multifamily side where there's waterfall structures and there's all these different hurdles. And I'm like, dude, it's so confusing to explain to a limited partner, a new investor. I know a lot of sponsors who can't even explain it properly. And so I'm like, with our fund, I'm like, dude, let's just make this simple. I don't want any waterfall hurdles and all that sort of stuff. So we just nice and clean, just a straight split.
Well, and what's great about your content is you can explain it and have it be a reference point. And man, it's just cool what you're doing. I think that you're finding a niche. I think you're ahead of the game, and
Appreciate
what
you,
you're
bro.
doing with the boutique hotels, how you pivoted from, what could have looked like a big dive down the short-term rental, portion of it. Like, I love what you're doing. I love that. I think that you find the right property and the right management, obviously the marketing that you have the ability to do. I think it's going to be a huge win for your investors.
Appreciate you, bro. And, I'm speculating and I'm always willing to be wrong. But I do believe that it's going to be the next big thing, which is why we're going all in on it right now. And I know 4 years down the road, 5 years down the road, conditions shifts, right? Market cycles shift, everything shifts. But there will be another point down the road where we probably pivot back to multifamily and start maybe buying more of that asset class. I do love that asset class. But I think right now our advantage just with everything that we're doing is the hotel space. So I love that. Dude, so you're starting a podcast, man. Tell me a little bit about your podcast.
Yeah, you'll see, you know, if you look at like my board members,
hmm
3 of them you just wouldn't find if you looked. And that's how I learned. I think that some people might have seen the same quote that I saw, like, hey, disappear for a few years and watch what happens. I took it pretty literally. And we're raising capital. We're utilizing AI and LinkedIn to create new connections and start new conversations around it. And we had a large sum of capital that have looked at us and said, man, we love you guys and we really love the vehicle. Our issue is that I went to look you up and I couldn't find anything. And this is my retirement. Like, this is my future.
Yeah.
And they're just in that confused part, right? They're in that nervous,
Yeah.
they're not gone, but they haven't converted also into clients. And so I just wanted to, I believe in what you're doing. I believe in creating content. I believe it's useful for business growth. I just had to get in alignment around what kind of content I wanted to create. I picked up my phone, I bet you close to 100 times, and talked about a deal that we were looking at or the underwriting or what we found or, a situation on an acquisition. And we put $2 million of non-refundable earnest money down on this property and we got in within 2 weeks and weren't fully funded. I tried to create it. It just didn't align. And so I just really sat back and had to find what do I like to do. And I'm really attracted to people that are good at what they do. And it's like, well, good's pretty subjective. And so all right, James, who do you really like to talk to? People that I would consider great at whatever they're doing. And it's like, I can talk all night. I don't care if you're a chef, you're an entrepreneur, whatever you're at. If you're good at it, I'm interested. And then there was this really cool story of a girl I took on a date I was telling you about.
More dating. Let's go.
Yeah. We were in high school and she drove a nice car and lived in a nice house. And she was in the bathroom a long time. And enough like I was worried about her. And she came out and she's like, sorry, I had to throw all the toilet paper away. I was like, huh? And she's like, yeah, my dad provides the toilet paper to this place. And so every time I come, I throw it away so they have to order more. And I didn't get caught up in as much in like how I felt about the ethics of that. But I got caught up on like, that's how your dad pays for all this with toilet paper. And I remember that story. I was looking for greatness. And then the idea of the podcast title came up, A Million Ways to Make $1 Million. I think that there's a million ways to make $1 million. And I'm spending time interviewing people that have made $1 million inside of a 12-month period and just talking about how they did it. And I'd hope it would serve people that are in search of, wanting to go create more than whatever they're doing right now. And I don't really care about the money portion of it. I just was looking to determine like, high level or high achiever. $1 million had a ring to it. And to your point earlier, this inflation, $1 million today is not what it was when we were little. You thought $1 million, I'm going to go buy a mansion and a Ferrari and I'm going to buy all this stuff. It's like, man, it's just not the same anymore. And I would hope that people could see it's accessible, or it's more accessible than ever. And now when people look me up, I would hope that they would see that, I feel really lucky to have the network that I have, the friends that I have. And if these people are giving me their time around the conversations, then hopefully I can lend some credibility as well to, our future clients. So that's where the idea came up.
Dude, I love it, man. Well, dude, I appreciate you coming all the way down, man, hanging out. You brought a little entourage here with you. Loving the black on black. You got some fresh veneers, it looks like, too, man. Loving that. Enjoyed talking, man, money, wealth, fun. Wasn't expecting to talk about laundry and level 3 spouses and all that sort of stuff, man. But where can the folks get in touch with you?
Yeah, A Million Ways to Make $1 Million is eligible on all the platforms. So YouTube, Spotify, Apple. My handle on Instagram, which I'm looking to be more active on, is J McCabe.
Let's go.
So, yeah, find me there. LinkedIn.
There it is. Go follow James. He's James McCabe. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you in the next one. Peace.